Traders, what's going on? Cleveland here.
Hey, what's going on, man?
Finally back. Right, definitely. Finally back in my old office here. Yeah, sorry about that, guys. But a lot of people sometimes misconceptualize the idea of a day trading methodology versus a swing trading methodology. When I'm trading my day trading strategy, it's really important for me to understand the underlying market participation for intraday players versus the underlying market participation for swing traders, okay? Just like how you hold positions for maybe a 5-minute time interval and a 5-minute time frame or a 30-minute time frame, there's big money guys doing the exact same thing. And if you understand the ebb and flow of that market money moving in the marketplace, you'll really be able to gauge and understand when to take profit, when to enter into positions, because you understand why and how the market players are reacting off of some of these intraday key levels. So it's very important to understand how different it is and how different a swing trading strategy is from a day trading strategy, because they're two completely different players, okay? So what I'm gonna do is we'll head over into the charts and I'm gonna break down for you guys mean divergence, because mean divergence is the basis of intraday trading strategies. I don't know if you guys know this, but the Forex market ranges intraday 80% of the time. All right, so if you're trying to do a trends trading strategy on a 30-minute time frame or a 5-minute time frame, it's gonna hurt you. It's gonna hurt your business, okay? So what you need to do is you need to say, okay, well, if I know that there's so much profit taking happening on an intraday level where the market literally usually just ranges and sometimes randomly breaks structure to the high, maybe comes back down, rests on the mid of some structural levels. We'll go into the charts and I'll talk about it. You need to understand that, hey, well, that's the style of trading that I need to be executing in my platform, okay? So what we're gonna do is we're gonna go into the charts. I'm gonna show you guys how I usually trade my mean divergence trading strategy and you know, how I exactly execute it. I usually keep inside Top Trader Pro, but I'm gonna give you guys the basics of it all right? So guys, let's pull over into the charts and actually, well, this is what we're gonna do. Instead of doing that, I'm going to go to a chalkboard and I wanna really break down mean divergence on a higher level, because I think that's the most important part. I can say mean divergence, but you guys may have never even heard that word before. So before we pull over into the charts, let's go to a whiteboard downstairs. So I'm gonna drink my chai latte. Guys, I love, this is my office, by the way. I love coming up here. I usually do a lot of book reading or you know, just kind of anytime I'm writing things up or even pushing out some content that's just kind of like voiceover work, I'm usually doing it up here. So if you're ever in the Atlanta area and you wanna come to the cool office, just let me know, hit me up, okay? But other than that, folks, let's go to the whiteboard. I'm gonna show you guys exactly what mean divergence is on an intraday time frame. And then what we're gonna do is we're gonna go into the charts. I'm gonna show you guys some live examples to really help you conceptualize, okay, damn, this is how I need to be trading intraday, all right? So guys, let's pull over to the charts. Get a quick view of city. I'm gonna drink some chai latte. I'll talk to you guys in a bit. All right, guys, so mean divergence. Mean divergence is a spontaneous increase or decrease in price action, okay, only to revert back down to its usual mean, okay? You can call that reversion or retracement, all right? But we're gonna get into that a little bit later. And a lot of people think mean divergence is simply as just, those are just, he's just playing retracements. I'm not. So just stick with me so I can help you understand exactly what's going on. So think of it like this. If you have a marketplace of buying at a certain price level, okay? Here, let's pull over. Let's say I like to use stocks as an example because I just come from an equities background. So, and it honestly is going to help you guys conceptualize it a lot more than Forex price, because you guys really just don't understand Forex marketplace and how it works. So let's say Apple is trading at $100, okay? And let's say we have 50 million shares traded at that price point, okay? And let's say some big institution, like say JP Morgan or something like that, decides to do something with their Apple assets. All right, so say they buy more. All right, say they buy more. Say they double up and they give Apple a new multiple. Say they figure it's gonna, they're categorizing it as a completely different sector. There's a lot of different things that they can do to kind of value Apple a little bit differently. And let's say they go from owning 2 million shares. I'm not sure how much JP Morgan would own. Okay, let's say they go from 2 million shares to 4 million shares. Guys, what you'll see is, you'll see a quick spike, all right? So let's say Apple goes from $100 a share and it spikes up to, let's just say somehow they pulled it up to $105 a share, all right? So most of the marketplace values Apple down here at this price point. But we have one guy that has entered the market, okay, a huge institution, just like in Forex, one guy that enters the market and that values Apple at a different price point, up here at $1.05, okay? So what you guys are gonna see is, there's gonna be illiquidity up here, okay? So they're called liquidity pools, and this is called a market inefficiency, okay? So let's say the actual chart looks something like this. Let's say we're trading, and the market's just been ranging down here in these lows, and then boom, you get a pop. You get a pop. So we know that there's a liquidity pool in the market down here, all right? But subsequently, as you keep going to different price points, market participants dry up, all the way up into these levels up here, okay? So let's say there's another liquidity pool up here at these highs of sellers. Same thing happens in Forex, all right? So if there's a liquidity pool of sellers up here in these levels, and there's a market inefficiency here, guys, what you're gonna have is, you're gonna have a reversion back to the mean, back to the true trading price, okay? Now, this is a very, very actionable and understandable way of actually executing an FX, because it just happens so much. You have enormous institutions that just throw in hundreds and hundreds of millions of dollars of assets into certain currencies, or into certain countries' certain countries' currencies, and you just see a huge spike. So this is why Forex is literally 5 times more volatile than other markets, because you have 41 banks with an immense amount of buying power, and you obviously have the central banks, but they're a little bit less involved, but you have these 41 banks with immense amounts of buying power that can just make a decision. And when these guys make a decision, it's usually a big one, and you'll see a run in the market, okay? So I'm gonna erase this here, and we'll apply it to FX. But I wanted to help you conceptualize it by using equities, because I think it's gonna help, okay? So again, let's say we're in the euro, and the euro's at $1.05. Okay, let's say the market pushes up and we're trading at $1.05. We actually got to $1.05 a couple of days ago. Okay, so boom, liquidity pool in this area. Now, remember, an efficient market, this is the next point I wanted to get to. An efficient market is a market that has buying and selling happening on a very frequent basis. Okay, think of the most illiquid markets. Okay, all right, let's trade the Turkish lira and the Mexican peso, right? That currency pair would be horribly illiquid and horribly inefficient. Why would it be horribly inefficient? Because you have so little market participants actually trading. One guy get in, another guy get in, they look like this, okay? You probably have really spontaneous price action with no true steady market participation at certain levels, because they don't really have a value for it at certain price points. So they're just getting in at any price point. But when you have a market as liquid as the Euro USD, which literally takes up 80% of most of the trading volume in FX, guys, you have so many players that have so much information and so much data on these specific currency pairs. What's happening? They're valuing the market at much smaller increments, okay? So literally they'll say $1.05 and 50 pips, okay? They'll talk about doing decisions at that price point, okay? They'll talk about doing decisions at, maybe $1.06 and 25 pips, all right? So, again, it's still not precise, so to speak, but, they have large gaps of trading activity, and in between those two positions there, you will coin these markets as inefficient. So what you can see is, let's say you have the market at $1.06 and 25 pips. Let's redraw it down here. Let's say this is 105.50, okay, and let's say this is 106.25. All right. Now, let's say there's a lot of buying activity up until this price point. Okay. Even still, you may have some spikes to the outside. Maybe some just heavy market players coming in. Obviously, you have an inefficient market, so you have sellers come back in and value the market back at its original mean. And then out of nowhere, guys, you have those amazing runs of the market where the market pushes really, really far. Okay. Literally, this is what, 75 points. Up into some structural level. That happened today, and I'll actually use some examples of how that happened today. On the Aussie dollar, Euro dollar, you'll see how the market's inefficiencies run the markets at different liquidity pools in the marketplace, okay? Boom, market comes up into a 106.25 level, and then potentially starts to consolidate at those levels. Now, the interesting part is, the market's not going to stay there. And a lot of the market participants that are trading in these levels and that are used to the market being down here in these levels are going to deem that market, that price as expensive. And if people are deeming this price as expensive, you may have a change of sentiment in terms of selling occur, or you just might have a lack of buyers. So either you're going to have a lack of buyers or have a change of sentiment. Either way, you're going to have a reversion back, a deviation, reversion, whatever, back down into structure. Now, a lot of people will coin that just as a simple retracement, and I'm not really coining it so much as a retracement. It is a retracement, it absolutely is, but you have to understand that not every retracement is the same, and you can really gauge well how much the market is going to retrace based on a multitude of factors. Let's throw volatility into the picture, okay? Let's say the market runs 75 pips in a span of 30 minutes, okay? 30 minutes, 45 minutes. Guys, what do you think is going to happen? Especially if that happens, let's change this up and say that that happened on the Aussie dollar, okay? Let's say that happened on the Aussie dollar, okay? The market's at 77.50, all right? If that happened on the Aussie dollar, guys, the ATR, the average trading range of the Aussie dollar is very small, all right? It's a pair that is really, really slow moving. Comparable to the GBP or the Euro USD, you'll see those pairs, really rip. The pound can rip, 150 pips, and you kind of say to yourself, okay, yeah, it's around average. But if you see the Aussie rip, boom, let's say the Aussie pushes 80 pips, guys, that's way outside of the mean of what the Aussie usually does. Okay, so since there is irregular buying activity happening, you have to assume that there's probably market inefficiencies. Okay, and if you understand that there are market inefficiencies and the volatility of that move happened quickly, then you can really gauge that, hey, look, that happened on a short time frame. Okay, market players that are trading in a smaller time frame are taking profit intraday as well. Just like how you take profit intraday, there are large institutions that do the same thing. And if you can gauge and see and say to yourself, wow, these are some larger institutional moves happening on an intraday time frame, you need to start understanding and gauging, okay, well, how much profit taking is going to happen, and quantifying how big the move is and how long the move took will give you a great edge in understanding how far you can take these deviations back down in. Today we saw the Aussie retrace literally 100%. 100%. It came to a low, I'll show you guys in the charts, and popped all the way back up out of the 77 level. Okay, it's amazing. So guys, again, understanding volatility is one of the factors, and understanding time plus volatility is going to give you guys an edge in saying, okay, the amount of time it took for this move to happen and how large the move was is very irregular. I need to start really coming to a conclusion and a basis on how much a retracement is going to happen and when a retracement is going to happen. Maybe you're looking at your higher time frames, your 4 hour or your daily, and you're kind of saying to yourself, okay, cool, market structure was hit on this higher time frame, it deviated way outside of its mean, this is an amazing trading opportunity. Okay, there's a less likelihood of this market, of this level breaking here, because the market is far outside of its normal deviations, and there's an immense amount of sellers potentially waiting here in this liquidity pool to push this market back down. So you have two advantages to that specific trade in that moment right there. Okay, so I'm going to go into the charts. I'm going to show you guys exactly what I mean. If you guys need to learn a little bit more about this, I have it completely inside Top Trader Pro. I go over this, very intensely, because this is how we're trading intraday every day. If you go in our live room, it's free to go in our live room, you'll see that we're using structural breaks and different fundamentals, and we're using Fibonacci retracement levels to kind of gauge how far the market can come down into, all right? So it's really important to learn more about it inside the Top Trader Pro course, okay? But I'm going to show you guys some examples from today to really help you gauge exactly how these setups are actually happening, and not kind of just see my shitting writing, okay? So we'll go over into the charts and we'll follow up after the fact with some questions and stuff like that, okay? Let's go into the charts. Alright guys, so just to revisit some of our talking points, there are a couple of things that you have to understand to win in an intraday trading strategy. First thing first, you have to be able to understand how the market is positioned at the moment, okay? Remember, if your overlying sentiment, all right, if the big picture sentiment is to the sell side, then remember, folks, statistically, you have a better advantage selling the market off. So you want to always build a directional bias for the week. Now, if your directional bias consists upon a reversal in the marketplace, well, then guess what? Yeah, maybe the market has been selling, but if you're preluding to seeing buying coming in, then what do you want to see, folks? You want to start taking potential buy orders, all right? Now, if you're in a range-bound market, your job is to be able to pick tops and bottoms
and understand more than anything when volatility is soon to come into the market. Okay, so here, that's the major talking point. The most pertinent aspect of an intraday trading strategy is volatility. Either you're waiting on volatility to come in based off of certain maybe fundamental data or maybe how the market is constructed at the moment, or you see volatility and you're going to take advantage of it by maybe going with it or going against it after you feel as if it's met a high. All right. Other than that, you waiting around in consolidation is not the business. Okay, you want to avoid scenarios like that completely. Okay, so right here we have the Aussie USD, and folks, this is about a good 2 weeks, 2.5 weeks of price action. Okay, if you have any kind of trend trading methodology in this ordeal, okay, you will not scale that well. And even if I push over into the Euro USD, we do see a sell-off on the Euro USD, right? Ever since coming up to that '08 level. But if I zoom in on the price action, you would have gotten whipped around viciously in this move, okay? So honestly, folks, you really have to understand the maximization of capital on these intraday levels. And when the market is perceived to has met its limits, okay? When it feels as if it's met its limits, if it's at the extension of what those market players can do that day, and they are soon to exit the market, or again, you may have market participants coming in assuming they've met value, maybe to the buy side, okay, or maybe to the sell side, assuming they've met value and they want to continue on today. All right, but if you're if you're just throwing an order into the market with no real idea as to if the market can continue its directional move for that intraday move, then you're gonna really hurt yourself, and you're gonna find yourself losing a lot of your trades. Okay, so let's just focus on the Aussie. Remember, underlying market sentiment to the sell side will aid you in a selling bias. All right, but I want to go to a market that is very, very trend bound at the moment, which is this Aussie dollar, which we have been playing very well in our live room. There have been a lot of guys being able to pick the tops and bottoms of this Aussie by, again, understanding volatility. So if I zoom on in, what you guys will notice is, there's two things you have to understand, okay? You have to understand liquidity pools, okay? You want to understand volatility, but you want to understand also apex, okay? The point at which a certain move has kind of met its high, all right? And you can define that by understanding when previous moves have met their high, okay? So even inside this 30-minute time frame, you have so many more areas of liquidity, but we want to more or less focus on the higher time frame here, the higher intraday time frame, which is the 30. Because if you guys start playing in the 5-minute and the 1 minute, you're going to be chopped around so much you're not going to even know what the hell is going on. Okay, and volatility happens on those time frames so irregularly, it can be a false pattern. Okay, it's called a false positive. You could assume that there's volatility that's coming to the market, and now you could maybe revert it back down into its mean, but it may just be again a quick price move that can continue for who knows how long. Okay, happening because you want to start functioning and structuring your business around when you perceive volatility is going to come into the market. Now, everyone really kind of knows, or at least you should, that Euro Open or US Open are really the best times that you should be executing, because that's when most of the market participation is actually happening. All right, so let's just assume this is where we start off here at this low. What do we get? Immediately, the market is sitting down here. It is a very efficient market, okay? The market is finding sellers, finding buyers, and then boom, we pop out of this high here, okay? We pop out of this high. We pop out of this low, and we push all the way up into this high. Now, there's a problem in this scenario, okay? You see an inefficient market. There aren't any sellers coming in to actually bidding this thing back down into structure, okay? And so, again, that's a problem for the marketplace. The market wants to always be at a level where it feels as if it is met its value. So it will always revert back down to the mean eventually. Now, remember, guys, we're focusing on these intraday positions, and of course, the market may, again, have that underlying sentiment to continue in a certain direction. That's not what I'm talking about. I'm talking about how if an intraday bank enters the market, okay, with $10 billion, okay, in a certain position, guess what, folks? It's an intraday market player. So guess how much money is probably going to exit out of the move, all right? Close to $10 billion. Now, it may take an extra day or two for it to happen, but you guys will notice an immense amount of volatility comes in, and then what do you get? A slow ease out of that market structure, okay? Same thing here. Immense amount of volatility comes in. We have some immediate price taking happening. But other than that, you see a slow, methodical move outside of the high back down to the low. Okay, so what's happening in this scenario is you're just having these intraday players, again, having some kind of idea based off of potential fundamentals. Okay, maybe they just want to get exposed. Maybe they have some clientele that wants to get exposed. Some big larger institutions that have an ideal of maybe buying this Aussie dollar up, and they just are trying to break out of these levels here. But guess what, folks? When these buys happen, when these buys execute in, I don't want you to assume that there's just buying happening at all these different levels. What you can imagine is, you can imagine a large order entering into the market, and as that order is being filled, okay, the value of the market is increasing, okay, over the course of time, over the course of these 30-minute time intervals. All right. So in this instance here, you have a huge order into the market. Okay. So let's say out of the $10 billion, you have $50 million get filled. Boom. You have an increase in price. Okay. You have more Aussie dollar being bought up. Okay. So that's heightening the demand. And as that order is getting filled into the market, again, you have this continuing to happen, and there are just more buy orders coming in as this order is getting filled than sell orders coming in. But once that order is filled, okay, it's done. Its cycle is over. All right. And so what you start to see happen is you start to see the market try to come back into some kind of equilibrium, and you see an overweighing of the buy side. You see too many buyers long in a particular move. So then what you see is you see a change in sentiment. Either those buyers are now ready to extract profits and exit out of this marketplace because, again, maybe they didn't achieve a certain price point they just thought the market could come up into. Maybe they did achieve a certain price point the market got up into. You don't really know. You don't really need to focus on that idea. You just have to understand that when you have a huge volatile move come into the market, you will see the market start to fold on over and start to come back and try to hedge back towards the equilibrium. All right, so immediately you see some sell orders come in, market comes up. Now you have to understand what higher lows and lower highs are, and the contrary to that as well. Okay, higher highs and lower highs. All right, so market comes up into here, it's a high. Okay, you see the market come down, a lower high, and then boom, you see a higher low, and then you see a lower low here. You see a higher low here. Okay, so what's happening in these scenarios, there aren't any buyers able to hold these levels up. Okay, there's an overwhelming amount of sellers coming in, and every time the market somehow meets a high, you see a lot of sellers come in. But when the market comes down to a low, there aren't any buyers in these areas. Okay, this entire weak leg to the upside does not have as many market participants to the buy side. So what do you see? The market slowly just easing on down, and then where does it start to find its value? Back down here at equilibrium, back down here at structure. Okay, so lack of buyers in these markets here, but look at all the structure here that gives sellers more confidence, more and more confidence to keep this market coming down. Quick up move, boom, low gets broken. You see more seller confidence coming in. All right, so we don't start to see large retracements until when? Look at where the market's at. The market has finally met some structure to where you may have some more convicted buyers, or some more, you don't want to say convicted, but you have some buyers coming in that with some strong opinions to buy this market back up. Okay, but again, overwhelmingly, where do you see the sellers come in? More structural areas, and then boom, we see the market fold over. All right, and guys, you'll see this happen time and time again. All right, you see the market rally out, even within this small swing here. Okay, the market wasn't able to hold that level here. So where did it find value? For buyers to feel as if they are able to come in on the market at a lower price. Boom, down here at this level. So market tried to rally out. It tried to rally out. It tried to push back up into these highs. If these buyers could have got this market up into this high, they would have loved that. But guess what? There wasn't enough buying activity, and there weren't enough buyers on that side for it to happen. Okay, so again, you see a rollover, but you see a weakening of sells. Okay, when did you start to see the weakening of selling occur? Right over here. Okay, so you see a shift in market conditions. Larger retracements are coming in. Okay, we see one more, fairly large finale to the sell side, and then you see a lot of them exit out down there at their potential profit-taking levels. Okay, so you see a large amount of sellers exit out of the market, and then boom. Okay, but not enough buyers in that sell, not enough buyers down here at structure for this thing to buy up. So potentially a fundamental catalyst, okay, gave them an ideal to want to push this market back to the upside. So then what do you see? Market folds on up, comes back up into this level here. This is called the apex of a move. And then what do you get? Market rolls back over again. So again, guys, we see volatility come in. Volatility is your best friend, but you have to use volatility in market structure that aligns well, all right? And it's not hard to find, but it is a practice to be able to identify market structure that will give you reliable results in terms of where to take this market into, okay? Remember, a noisy market is bad for everybody. You don't know where to take profit. You don't know exactly where to enter in a certain move. So that's why you don't want to play a market noise. You want to play in a very efficient market. And then when the market does become inefficient and just you see random spurts of volatility, okay, that's where you execute. Hopefully we'll see some examples of what I'm talking about, all right? So market comes back up into this highs. Sellers do what? They're able to break the low. Now notice these sellers weren't able to break the low here, okay? They weren't able to break the low here. But when were they able to break the low? Notice they were able to break the low once they came and had the larger retracement. The larger retracement gave them the ability, and I'm talking about the retracement of this swing here, okay? The larger retracement back up into structure here gave them the ability to get in, all right, more sellers to get in at a better price point, okay? And so what happens when you have more sellers getting in, okay? Market comes down, and then it's now able to break the low of structure here. Because remember, look at all the weak buys. Buyers weren't able to do anything with this move at this point in time. Okay, buyers came in, buyers ripped the market, fundamentally tried to get in on some potential up move. Okay, but other than that, folks, what do you have? You have the market roll on over, all right? So again, we know this Aussie market was very range bound as we continue along, but it's just really good to kind of come in on the market and actually like see the details of these intraday moves, okay? So as we move on over, what do you guys expect? Before we see anything else, do you guys expect, knowing how the market is range bound at the moment, should you expect the market sees value down here and is going to continue selling? Okay, is that your ideal? Or do you think that the immense amount of volatility that came in on the sell side is going to cause what? Remember, you're going to have all these short-term market participants long. That's one fact there, okay? Now, what happens when everyone's short? No one's able to keep going short. Okay, and outside of that, what happens when the guys that are short feel as if they've met value, when they've maximized profits? You're going to have, again, another point, people actually extracting profits. Okay, they're going to be getting out of the market. Outside of that, what happens if you're going to find buyers that feel as if they've hit some type of area of liquidity that the market is deemed cheap? What are you going to have? You're going to have an up move. Okay, so is that going to happen here? Who knows? Who knows? Let's just take along. And then you see the market start to hold these levels. And now we're actually starting to see some kind of efficiency happening. You see buying and selling happening, and it's very tight. Remember what I mentioned before, if the market is doing this on the whiteboard, if the market is doing this here, folks, this isn't a very efficient market. You only have a couple of people in this thing that are able to buy the market at certain price points, okay? But now, notice what we have. We have some actual participation happening on this intraday time frame in a tighter area, in a closer what you can call a tighter spread here, okay, from this level here to this level here. Now we're finally finding scenarios that where we can say, hey, look, has the market found value at this level? Okay, and is there still an overwhelming amount of buyers that are ready to get in because they feel as if they can actually take profit up into certain structural areas? Are there still too many sellers in this move to continue breaking this low? Now, how do we conclude that there are too many sellers in, that buyers feel as if they've met value and that they actually want to execute on this level here? Well, guys, the way of figuring that out is seeing this level broken. If this level gets broken, then there's a probable chance that this level will continue to the next. And that's trading, right? You want to take the market from level to level, but even more than that, you want to take the market from level to level in a predictable manner, okay? So this is one of my favorite trades here, a 23.6 break, okay? We won't go too much into that because I like to save that for the pro course, but at the end of the day, that gives me a high conviction or conclusion that I think the market's going to continue to higher retracements, all right? So as you see, what do you get? Market comes up, spikes the low. Remember, it needed to look for a little bit more sellers, but the awesome thing is we didn't get faked out too much, and the market pushed all the way back up into where liquidity. Notice how, where's this thing at? It's right here at this same zone there. Okay, now how interesting is that? Okay, now if you ask yourself that question again, do you see how it's a little bit harder to, kind of figure out, well, is the market at another price? Now what do? Okay, do you start to sell it off? Has it retraced enough to continue breaking the low? Okay, or is there still too many sellers in this move? All right, maybe buyers haven't found value here, but are there still too many sellers in this move for this market to push back up to the upside? Now, here's the thing, folks. If you're in a trending market, it could be very easy to conceptualize how this market could have met a high here and it could have rolled on over. But if you're in a consolidated market, hopefully you're sticking with the ideal that this thing could push potentially all the way back up into the high. Okay, but you have to be able to identify that the market's consolidated or not. Okay. By just, again, looking out on those larger time frames, all right? But notice market comes back up in. This is still a fairly weak leg, so you may even see the market come down and rest on certain levels, okay? Tries to push out again, comes on down, okay? Notice that there, folks. Again, this was still a weak leg. This was still a weak leg. And not only that, we found value right here at these levels. So you see the market pull on over. We still didn't have enough buyers to push out of that high here because we're now at strong structure, okay? And then eventually you probably have the market finally coming back up into structure and finally being able to penetrate and hold certain levels, all right? But this level wasn't strong enough here. Let me go back over to potentially the oval. This level wasn't strong enough here for it to break that high, okay? So it's obvious that this market had to roll on over. Now, how far can it roll on over? Again, once the market starts doing its thing and starts creating certain price structures that are harder to identify, then it's hard to say. But this price structure here was one that I identified, that I use very regularly, and guess what, folks? It panned out to be fairly well. But notice as price continues to create more levels, it's kind of hard to kind of figure out exactly where you can take the market to, because then what happens, it just gets in a tighter and tighter range, all right? So if we keep pushing forward, folks, again, it's the same thing. We're telling the same story. You see the market come up, boom, market comes up, retraces, finds more buys, and then boom. Why did it come up into this level? Well, obviously we couldn't hold this little level here. Market comes up into this level and it was able to break that low, okay? But remember, that's just going to keep happening in this trending scenario, all right? In this range bound scenario. So understand how mean divergence happens, folks. You want to see a lot of volatility, all right? Notice when there's not a lot of volatility, you don't really have a high opinion of what the market's going to do. But notice this, boom, we see a ridiculous amount of volatility come into the market. So what do we have? A large retracement. Remember, the more volatile the market, the more market participation is, at its extremes, okay, the more likely it's going to deviate back down in the structure. So if we only look at the price formations and the market formations, the structural formations that have these large, just enormous candles, okay, is that your edge? Maybe that's what you're trading, okay? If you're trying to trade little scenarios like this, that have the smaller candles, yeah, maybe there still is a probability that the market may, revert back down in a structure, but you have to ask yourself, how much volatility should I look for? So then you can start systematically creating an actual model and saying, hey, look, I need to see the market, on a 30-minute time frame. I want to see candles at this size or at around this size. Give it dimensions, okay? So let's see how long these candles are here, all right? So here we have a 28 pip candle in a 30-minute time span. Is that enough for you to say, whoa, that's a lot of volatility? We should see this market pull on over. I don't think there's going to be more intraday market money trying to bar the market up at those levels there, okay? Is that how large of a candle you need? Who knows? I'm just drawing it up here. I just want you to ask these questions so you can start building a model, okay? So if we pull on over, again, notice this here. We have a huge extension to the upside, all right? Now, ask yourself, is this a level that the market can hold, okay? We know that we're at the high because if we pull back over, we were at the high previously over here at these 76s levels, these high 76s. And as we know, the Aussie has had a horrible time breaking outside of that, breaking outside the 77 level, even since 2015, okay? So you're just now asking yourself, can the market sustain these highs? Notice I didn't start really wanting to I didn't really draw up any levels in this mess because the market's too choppy, it's too ugly. But I love the series of extensions here. So this may be a move where I can see the market revert back down into structure there, knowing that it's a trending market, okay? So if you pull on over, boom, market, it does break the low. Where does it find its level? Finds structure here. It finds its low here at structure again, and then we kind of range down, and then eventually we do see the market fold on over, okay? So again, guys, volatility is something you need to look out for. If I pull out, you can see this thing on a larger scale. This is the price move that we were playing in here, okay? So volatility is something you need to look out for. Volatility is your friend, all right? Every time we see an immense amount of buying happening, you see the larger retracements coming in, okay? So that is going to give you a better opportunity. All right, and so understand, I mean, look at this, boom, huge amount of volatility. What do we get? What do we get? We get extremely large candles here. We get two 20, 30 pip candles in a row on this 30-minute time frame. We have an immense amount of selling coming back into the market, okay? Same thing here, boom, huge sell. We have a huge buy. Able to buy, this sell-off was able to get the market to break this high here, okay? Again, very interesting, all right? So, and as of right now, we are on President's Day, so the market's very illiquid right now, okay? And even since then, we did have the market sell off here. But guess what? Look what happened. The market sold off here, and then what did it do? It came back up into structure, found the inefficient level, all right, where the market deemed itself as, again, expensive, and now rolled back over. So now what can we see? Who knows? All right, we're going to see what happens on a Tuesday, Wednesday, Thursday for the rest of the week. But you should just use this to objectify your trading, okay? This should help you conceptualize that mean divergence, all right, and understanding that playing trending style trading strategies can really be dangerous in terms of how you're going to be executing in day trading, okay? I like to use range-bound strategies when I'm day trading. I like to pick tops, okay, and bottoms. Now, I know that sounds, again, it sounds very improbable because everyone says, oh, never pick tops and bottoms, roll with the trend. No. Statistically, you can see how if you try, what trend here, and if you roll with the trend here, I bet you're going to get washed out. So it's so important to understand the positioning of the intraday money. When intraday money can't go any more long or any more short, understand that it's going to revert back down into where it perceives its value to be. You may have the underlying sentiment have smaller range-bound, smaller retracements. Okay, just like here, euro, look, couldn't retrace back up into the high. Why? Underlying sentiment, guys. People didn't want to buy. People didn't want to start buying the market all the way back up because they understand that the market was pushing to the sell side. All right, and then eventually you see the levels get broken. Now, notice how choppy it's getting. Now, why did it get so choppy here? Well, that's because if I pull out to a 4-hour, you guys will start to notice that we've come back down into structure here. Okay, so that's that same level right here that we were just looking at. All right, and this is that Euro USD. Let me pull over into the daily. So again, you can understand how price can shift in terms of its actual patterns. Okay, so notice came down into that 50% retracement there. Market found value. All right, and now again we started to see some buys come in, and I've actually been wanting to. I think I've wanted to take this intraday buy up in the structure there because of this move here. I saw the market push down. I felt as if we pushed down a little quick, okay? I felt as if this level here could be broken, and I felt as if we could push to those highs there, and I think we could come up in here into these 40s, okay? So that's something I am looking out for. Guys, if you have any other questions, let me know, but we'll continue with the segment with the best Forex intraday trading strategy.
So remember, traders, defining the catalyst, defining the variables that make the market move, okay? Time of day, you have support and resistance, you have news, you have fractals, something that I go over intensely inside Top Trader Pro, and again, you have volatility. Understanding those variables and aligning them to an actionable system is the business, okay? Is the business of conceptualizing a really good day trading strategy. All right, so yeah, you can have technical analysis. Yeah, you can have moving averages, and you can just stick to your technicals. And again, I'm not saying that it is imperative to understand news on these higher levels and understand monetary policy and stuff like that. But just understanding the underlying sentiment of market decisions is extremely important. And if you don't know, and if you're missing out on one of these catalysts, there is some trader in the world that isn't, and that is using it to their advantage, okay? So you gotta stop scaling out of technical analysis, which is what every single trader, retail trader does. Everybody, 100% of all the traders I run into that come inside Top Trader Pro scale out with technicals. They only talk to me about fibs and they feel like that's the last bit. Or they only talk to me about risk-reward ratios and they feel like technical analysis and risk-reward ratios and you're winning. Not true. Far from the truth, okay? You have to understand market participation. You have to understand the underlying business of buying and selling and why it's happening and how these banks and institutions are coming to these conclusions to buy and sell at these levels. Remember again, these aren't candles, these are people with fear and greed, just like yourself, all right? And they're making decisions based off of them understanding when the maximization of profit can happen and how to limit losses, because they do lose, okay? So if they're trying to maximize profits and if they're trying to limit losses, you need to be doing the same thing by following them because they have the money, all right? So other than that, folks, again, come to the office. What I'm gonna do is I'm gonna put a link down inside of this video here to our free trading room, okay? So join that free trading room, and that is gonna be your edge to really conceptualizing and understanding this on a higher time frame, all right? I'm getting a little sleepy, so I'm gonna grab one of these Cokes. Guys, again, your profit, always my motive. Contact, this isn't an advertisement, by the way. Sorry, it's pretty good though. Contact me if you have any questions. Other than that, guys, profit's my motive. I'll talk to you guys real soon.